where I share my 45 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. In tonight's video, we've got one boring week ahead, but I think it's going to be a day trader's heaven. So let's get into tonight's video. Well, welcome everyone. Probably a few people coming in late. I'm sorry I'm late again. Had equipment issues, finally got things running, and it's Sunday night. So just a quick announcement before we get too deep into things. Thanks everyone for coming. I don't know what this week has ahead. I think it's going to be a volatile week for me personally. And so I'm going to do my best to cover the week in case there's some interruptions in the channel this week. So there's a lot going on in the background here. So anyway, showing up for tonight, I got kind of excited actually. I was looking at the news coming out. It's like super boring. I'm just looking up at my upper screens here, and you know, we've got LEI, which no one cares about. The only thing really is the claims and the continuing claims that come out. The Fed's going to be in a quiet period because it's the 2-week period coming up to the FOMC. So we're not going to get any rhetoric out of the talking heads out of the Fed. And so not much is going to happen. And we're also seeing that the volatility is contracting pretty heavily on the weekly charts as well. So we're still getting that squeeze, and sometimes the squeeze play will be a breakout, but typically it's to the downside. So we continue to struggle, I guess if you want to call making all-time new highs struggling. But if you look at the last 3 weeks, we've been range bound, and it's been kind of, we've been stair-stepping. If we go back all the way to the April, we got the big recovery, and then since then it's just really been consolidation, little bump up. You go from mid 62s, now we're mid 63s, and we're continuing to grind in there. And there's still a lot of upward momentum. So that doesn't mean that there's a big rollover coming. But as I've been showing you the last couple weeks, and we continue to have kind of a upward slope, meaning we got an underlying bid that's in the market. So the buy the dip trade still works, and it should still continue to work. But what I really expect is this range to continue this week. And, you know, there's, like I said, there's nothing coming out other than continuing. You got a bunch of deadbeat reports coming out this week, really. You know, there's, so what that means is the algos aren't going to have anything to play off of. So that is, I think, the only significant thing. So, and I'll set this up when we go through the S&P and the markets here in a minute. But there's going to be guardrails. Basically, this range is going to be guardrails. So you're going to be able to buy low and sell high, right, within a range. And the good news is the data sheets that I'll have out in the Substack will help you to define those ranges with the market grid. I don't expect any breaks of the market grid. So this is something that I want to mention, is that's the beauty of the market grid indicator. You know, I've had people tell me over the years, oh, these are just random numbers, all that. But there doesn't, if you create, let's say it is just random numbers. They're not random numbers. They're numbers that are being generated off of the ranges that come out of every day, the volatility and the range volatility, and that gives us some predictability to the next day. And what I've always been, those were developed, I'm trying to think what year, I believe those were developed around 1992, 93 when I developed those, and I've told you folks about this before, but they were developed when I was working in a hedge desk, and we needed to come up with the best place to do buy and sell hedges on primarily on treasuries. I've worked with a lot of big banks on as a consultant, and all we needed to do, if I needed to put a short hedge on, I needed to know the best place to sell that day. Those type of trades, I remember when I first got into that arena, people said, well, you know, you don't do things because you think it's going up. You do things because you have to do them. So when you're running a hedge desk and running where you're trying to lock down prices inside of a giant portfolio like multi-billions, you have a whole different methodology. So that's what they were built for originally. And so what came out of it, I realized how darn good they were in predicting potential ranges. So now we've turned forward the data sheet that I'll show you here in a few minutes on the S&P. Not only does that, but we now have the ability, because of the AI, to be able to come up with some probabilities of where the ranges are going to be. And everything, when it comes down, and I'm going through this scenario because my whole premise of this stream for this week is that we're going to have guardrails. So those of you who are trading, those of you looking at swing trades, it's not going to be a very good week for you. But those of us that are traders and ranges, if you have the guardrails off and you know you're not going to go off the cliff, you're going to at least bounce off the rail, then you can really get pretty aggressive with making some money. So I'm excited about that. But those ranges, the predictions, all that stuff is happening. Not sure. I have a meeting tomorrow that we're trying to put together the launch criteria for the data sheets, so you folks can use them on everything that you want. That hopefully that we're actually at the final stages, just really getting into that. We're pre-launch phase, and I'm not sure how long it's going to take. It just depends on what happens. There's going to be email. There'll be a link in, not tonight, but there'll be a link in the YouTube channel as well to sign up to get on that launch strategy. A lot of you are automatically going to be on it. Those of you that bought the indicators before will be on it. So, but still, I would suggest that you sign up so make sure we've got the right email address, all that kind of stuff. Anyway, so, but yeah, so to really stay in sync, if you haven't get the Substack, then kendallreport.substack.com is going to get you to there. So advertisement over, but this is pretty exciting stuff. But back to the day trading in the ranges, I would say on individual stocks you're going to have dynamics there, but I'm talking mainly the indices stuff, NASDAQ, S&P primarily. Okay, so when I go through the rest of the analysis, and you'll get that perspective anyway, and I'm hoping that I can, the Substack it'll be pretty easy for me to maintain that, I believe, going through the week. There's some other points of things of volatility that could happen to keep me from doing a live stream. But the point is that we should see, I think, some pretty good ranges, and probably going to last into this next Fed meeting. And that comes it's interesting because the next Fed meeting comes in at the end of the month, right? So it's 29/30 is the Fed meeting. And so I'll save that. I think we got plenty of time before we get into talking about those guys. The Fed's pretty irrelevant right now. They don't have any use at all, actually. And I've been saying that for 3 months, and that's pretty much it. So we'll leave that there. But the suggestion that I would tell you is, if you're a day trader, get excited, okay? Because I think these guardrails are going to be pretty clear cut, and especially if you're on my newsletter, then you're going to have those parameters of those data sheets, and those are going to be key. And if you have the indicators, then you have them. You have them on your own desktop. So the indicators, in case you want them, kendallreport.com/indicators will get you to a place to find out more. And our whole infrastructure is being updated in the background right now. So I've been working on a big project, and I've got a couple of real exciting things as we go forward. I actually have our models. One of the models right now is just about complete. That's in WaveTech. I think it's version 1.2 model is pretty close. There's a couple of things that need to be tweaked, and then there's going to be another release of actual models. So if you don't want to get the portfolio manager to get those, then that's going to be there. My goal is so you guys don't have to know all the nuances of the PPMs to use them. So you're going to have intelligence through primarily using Claude. And I've never taken these TSX files and thrown them into ChatGPT. The nice thing about Claude, it actually generates the artifact for you. Anyway, enough of that. But yeah, so let's talk just a little bit about what I'm going to finish doing tonight. And I'll try to get through it fairly quick since I got started late. But I think the markets are setting up, and I've been talking about this for a while, that somehow they're just kind of a soft roll, and there's still intermediate and longer term things that are going on that are going to help us to, I guess, build our expectations of where these markets are going to go. I don't think there's any big declines. I don't think there's any collapse. Those are fun times when everybody on the internet, everybody on YouTube, and every influencer and trader and everybody in the world start screaming the world's coming to the end. Those are usually pretty good times to buy. But there's none of that right now that I see from my techniques and all of the data that we have. We're not seeing that. There is some disappointment I'll talk to you about in a minute that tells us a little bit more. Maybe I'll try to wrap this up here real quick, so hang with me a minute to try to kind of figure out what's going on the next level. I've been talking about this Q3, Q4 recessionary / soft period in the economy. I think the markets are struggling trying to move forward, and I'm starting to see signs that maybe I'm going to get confirmation. As you go through week-to-week data, when you do, typically I try to do live stream Sunday through Thursday, so every day, and I write newsletters every day. You can get wrapped up into the noise sometimes, and I'm not any different than any of you. Sometimes the noise can be so loud it's hard to ignore, and it will influence you. So that's always the case when you're being an analyst and being just an individual. You have to realize if you're an individual trader using discretionary techniques, you're your own analyst. The problem is what we do within that context and try to get some structure around it. I found a really good prompt the other day that, and I'm going to modify it. I thought it was pretty brilliant what somebody did, but they put a prompt together to actually do analysis of your own trading and set up some trading rules and things to do. And I was pretty excited. I saw that. I go, man, I could get everything to kind of get everybody within my universe with using indicators and step-by-step process. It was pretty cool. I just been hitting walls on time lately and getting things done. So anyway, so here's the plan. We'll go through the database and go through all the stocks. I'll look at the weekly chart, so I give you the goal for tonight's show will be able to set up these guardrails for the trading for the week. I think there's little or no chance to break below or above these areas that I'm going to discuss tonight. And even if you do, you can have basically you can put your seatbelts on when you're going down. It's like I'm picturing I drove from upper state California down 101 all the way to San Francisco from up north, and it was the scariest thing I've ever done in my life. It was like cliff after cliff. If you went off, it was like 1,500-foot drop. I don't think we have to deal with that, but I think even if you drive off the road, off the side, there's no cliffs, but there are some clear things. You can get yourself in trouble depending on how you go. So, all right, so I'm also gonna bring up really quick some further context on the Dow, and we'll do interest rates as well. So we're gonna do database, S&P, NASDAQ, and then go through interest rates, the Dow, gold, and Bitcoin. So let's do it. All right, so this was a bit of a disappointment that I had, and I'll show you. I had kind of set you up on the Substack on Thursday night, and I was talking about the potential of the database, since we've been punching all-time new highs on NASDAQ and the S&P over the last couple of weeks. I was watching to see if we're going to get any magnetism toward those, just the Mag 7s and the NVIDIAs running and all that. Are the secondary stocks within the index or within the database, are they going to stop or start to participate? And I thought we might get up to 58%. Well, you can see on the screen here, we're looking at 54. We got roughly a little bit over 200 new buys, and we got more sells. I was really shocked when I saw that. I thought, wow, we actually got selling coming in while the market's going up. So it flashed me way back, and I'm not, people are going to draw some conclusion on this, but I'll make it clear. Back to like in 2020, right before the pandemic, and this happens with this database sometimes, but we were at little more elevated levels in 2020. If you remember, right before the pandemic happened, the markets were trading all-time highs at that point in time. And then they turned the economy off, and we got the collapse and all of that, right? But what was happening coming into that, you folks didn't know me before that, but my institutional clients and I'm getting phone calls from portfolio managers like, Bob, why are we getting all these sells coming into our database? So what's interesting about this database is when you don't get the push when you think you should, and that's what I was talking about. If you don't get that big to come in, I talk about all the time, and you start to see some enthusiasm and more buying, and we're at 54.15. We were I'm flashing back in my mind, but we were just 52.5. So so we're seeing a flat performance here in the intermediate. Pretty disappointing from my standpoint, because we're not seeing that traction. So my conclusion is that I'm not 100% here. We'll see, because we won't have another snapshot until end of the week, and this will be the final snapshot of the database before the Fed. And so if we don't get some traction, I thought we should have had traction 2 weeks ago. Now it's lagged. Last week we got a little traction, and now this week we're getting just a bit negative, and no big deal. I mean, there's 14,000 plus symbols, 14,615 symbols in the database. So a couple hundred variants from the buy and sells is not a big deal. When this thing does, if it rolls, we'll literally get 2,000, 3,000 exits all at once. And I was just hoping we get, basically 500 or 600 new buys versus a couple hundred sells, and just continue to see some traction, because the database has some clear numbers. You have the metrics are 58.62 is the next kind of resistance zone, and it normally on an intermediate basis doesn't get much over around 64 to 68. I have seen it up at 90% back in 2008, and also after the pandemic. And that's when everybody was telling me in July of 2020 that the market was going to turn around, make new lows, the end of the world is going to happen. I'm going, no, not really. That was when we bought the airlines stocks, I think in May of 2020 and made 100% by year end on 12 stocks, including having Boeing in there. So yeah, so the database is pretty good at forward looking. People always tell me it lags. It doesn't, because they think it lagged because last week was up and now it's buying, but it's really about the forward-looking expectations from the database. So I try to give you folks that kind of experience and that ability to look forward. So, but nothing here, and we go over. We did see something else happen. So let me go up to the daily and just look at this real quick. So daily now is 67.92, and you're if you haven't been to the channel, I think, hey, that's a lot of stocks. We've got almost 10,000 stocks long, but what's happened, we were around 75, so we're starting to see it stair step down. The goal of 58 to 62, that range should represent support. If we hang around there, maybe we get some rotation, but I'm thinking all of this stuff is way beyond the Fed week, 2 weeks from now. So maybe as we come in the 1st of August, we get something, but I've been talking about summertime blues, man. That's deep in the summertime blues in August, and it's probably not going to be September. I think September and October is where we start to see some formation. I'm going to show you something here in a minute. I'm getting longer winded than I thought I would, but there's from a technical and quantitative viewpoint, there's more to talk about here. So when we get, I'm going to bring up the weekly charts on the indices, the S&P and NASDAQ, and they're showing potential loss of momentum all the way into November. And this has been a forecast that I've been talking about for a while, even though we continue to grind up on the ceiling of the market at all-time highs. There looks like there's going to be some attrition to come in, and I suspect that will be for all risk assets, including everybody's favorite market right now with Bitcoin. I think everything's going to kind of stall out. We'll just see how it unfolds. But that's what all this lack of follow through. If we continue to see attrition on the daily models and we get into that 58, 62, then we'll see if that able to hold, because after that we're down into much bigger issues from that standpoint. And yeah, we'll just have to ride through and take a look. But expectation is continued losses in holdings on the daily, and maybe we'll get some traction next week. We're just going to run by the numbers right now, because that's all you can do. Like I said, there's literally no economic news coming out. We do have, and one of the things, I apologize, I'll bring it up in the Substack tonight, is the earnings that are still coming out, but a lot of those are getting very muted as well. So anyway, let's move on. Let's go to the charts here. I've already got it on weekly, so let's go top down here. So the weekly is, this is what I was talking about right here. If I'm going to zoom in on this, there's still some underlying momentum on the 21, but we're seeing the 10. We've crossed the first derivative, and all that tells us is that we should most likely come down to the 10-period moving average, but the 10-period moving average is like still very robust uptrend. Okay, so any declines, this where we'll set up the guardrails here. So if we look over here, and I'll bring up the data sheet here in a minute on the daily, but what we're seeing here is that the range expectation right now, we're up 7.25. We're printing 63.42 on the S&P. So we're looking at this is the market grid area. So this is your weekly grid area. I'll make that a little bit bigger. So if you're watching the video, you want to pause it, pull out these numbers. But these are this is the range right now for this. Let me look at something here. Yeah, okay. Just want to make sure I had the right contract down. So for one reason or another, I'm not seeing this thing update here. Let me look at something here. Okay. All right, that's the right numbers. Just didn't look right. So yeah, so this is going to be your ranges of expectation. So let's go to the daily. And then we'll bring up the sheets. Yeah, so this is what I was talking about. We got a slight downslope. Slight downslope here, but if you notice looking forward, the WTRs, the moving averages are still, this is what I was saying, this 21 is still pretty strong. So we're looking at those values right now. The 21 is around 70, 62, 74, something like that. It's going to be your range. You see the red dots are kind of bouncing off of this area. That's because of the angle of attack. When we programmed in these algos here, they respect that angle of attack. So it's looking at the angle of attack and the potential for it to flow. And I won't go into any detail on the algos themselves, but that's just telling us we should roll right into this 63, maybe 62, 75. It's not going to be, this is my point. There's no really big, deep declines coming. So the ranges are going to be pretty good to trade off, I think. And in fact, we'll see what I have to publish this sheet here. Give me just a second, it's a couple clicks. Okay, so let's go up. And let's put this. So this is where, if you're getting the Substack, you're going to have this sheet in here. This sheet will get rerun before the New York Open in the morning. So, but this is where it is right now. A lot of these numbers here on the support resistance probability grid. This is the market grid, what I was talking about earlier in the video. That's going to give you the ranges. So right now, 47, we're printing 42. That's 55%. And there's only a 35% chance to get to R2. I'll show you it's interesting what it's picking up on, but let's go through the PPMs here. And let me move that over just a bit. Yeah, so if we go through the PPMs, right now all the PPMs, PPM1 is in neutral. It's below 0.15. You see down here, these legend will tell you what this means. So N is neutral, M is for maintenance, which means there's still underlying trend, and that's the 21 period moving average. So the PPM2 tracks to 21, and that's telling you it's still at 0.23. It's in maintenance mode. Right where it is right now, there's only a 40% potential for it to go below that moving average, and that moving average right now is down here at 62.50, and that's kind of goes to where I was talking about. So right now there is only a 60% probability will remain above that number. So all of these are telling you what the angle of attacks are, what the probabilities are. If it's in maintenance, it's basically you can use a rule of 60-40. And then what's nice about this sheet, it's actually going to do a commentary and tell you about the characteristics which I programmed in this sheet to do the analysis for you. So here it's looking at R1. uh, we're looking at the key levels. This is what I was talking about. R1 is 63.47, and I think when we come down here, one of the trades for today, it's interesting. I don't know what it is, but I did this sheet right before we came live, so it's early on. This will get updated in the Substack tonight later. And these sheets, when you do get your hands on them, they are very relevant. Some of the stats and some of the analysis is relevant to where the market is real time at that moment. So there's possibility that you might rerun these things if the market shifted quite a bit to see what that analysis is updated. But the bottom line is, this is the case here. So I just wanted to look at one more thing. Yeah, so it's still got the cycle mid-range, very low, extremely tight range. This is why I'm talking about these about the guardrails here. So daily, if you have the Substack, you'll get this. I know if I'm doing videos right now, you can grab these ranges right now off the video to help you with your trading. But like I said, it will be updated later tonight. But this is the ranges that are coming into play right now. So it's given us all of the probabilities as well. There's one other section to pay attention here, actually two, is to start to look at. Hang on here, there we go. Start to look at some of these Fibonacci patterns and level targets. Right now, there are no Fibonacci targets in here. It will actually tell you that there's any targets right now, and so there's. I think this reflects what I'm trying. The theme of tonight's video is that there's not a lot of volatility expected ahead, right? So back to the chart. Let's just take a couple quick glances. You can see. Look at the PPM's forecast. These dotted lines are the future forecasts. These go out like 150 days. But just at the short term, looks like maybe a little weakness. But for the most part, you're looking at stability. You're not looking at any trends develop. And in fact, the underlying trend here is up here, like I said, at right now at 0.2. We're still in a trend mode up on the PP on this, and that's a red line that's coming here. That's let me just zoom in, and then I'll just talk about this when we go through. This upward slope red line, that has a 60% probability. So if you see anything that looks like the 21, that's pull the truck up and load it, and you should get this forecasted bounce. We should get a decent bounce. So I have to actually be clear, because I get a bunch of people watch the video, and they might like to, try to make me. I guess that's the goal of the internet, try to make someone look bad and try to make them wrong. So the analysis is clear, is that what we should do is come down to these ranges. The probabilities are very low at the moment, could change by Wednesday, but at the moment, they look like we should hold this value. So that's going to be guardrail 1. On the top end is just going to be the daily market grid numbers. So you can look at those extremes, but most likely, real quick, because the way I set up this video for tonight, the range that you need to expect is probably on the dailies is looking at S1, R1, which is support 1, resistance 1, and then there are pivots after that. So if you break through R1, then R2 is the next pivot point. If on the downside you break S1, then S2. So they're really good to watch, and sometimes you'll see the sheets put out these trades where it recognizes the configuration of the PPMs to bias one way or the other. So they'll have, if you break over R1, then your target's R2, and the inverse where if you break S1, and it will identify that. And that has everything to do with the angle of attack, what the probabilities are from that. And anybody's traded a market, and I've been doing this for 45 years, um, and but anybody knows anything about the markets knows that the markets are probabilities. You know, trend lines have zero probabilities. They have no real. I know people hate when I say this about trend lines, but they're the worst thing you can use to try to trade and do breakouts. Don't do that. And the other thing I hate about trend lines, it makes you think there's a floor and a some kind of ceiling around the market, and there's a wedge and all these stupid Edwards and McGee ideas that never work. You know, when you see Head and Shoulders and all these things people talk about, they read a book that was written 50, 70 years ago, and anyway, it's possible that AI could test some of these things, but you'd have to have a lot of data to do it. And I've always joked is I've only seen two Head and Shoulders, actual, legitimate Head and Shoulder patterns in 40 years. So just because I don't do that, so I'm discrediting it, but it's really, really not good stuff. But what we're looking at here from the aspect of the angle, you can see the trends are still very much intact. So that's we got a couple things going. We've still got 67% bullish in the database, which is one of my primary things that are going to drive my activities. And then we're 55, roughly, we'll just round off 55% on the intermediate, which gives us a big foundation underneath this market. This is not the market it collapses or big decline or anything starts. Now, if something breaks, like it was interesting, I mentioned the 2020 situation, right? Well, we were heavy selling in January and February prior to when they turned the switch off. So we were actually approaching something like 30-40% in cash when that happened. So we ahead of that, okay? So by the way, same thing happened in 2008. We were selling ahead of, because all the internals of the markets were breaking down. A lot of people look at advanced decline lines. That doesn't mean much to me. I looked at it many years ago, but basically what the WaveTech database does is giving you not an advanced decline line, but how many stocks are trending versus not. And that's why these percentage data, all the percentage data means something. And so we're looking at those numbers, and right now none of those numbers are suggesting there's any kind of rollover or anything. So don't try to make me a bear, because I think we could trade down to a 21-day moving average. But what we're looking at is, you can see the trends being forecasted are still elongating, and let me zoom back in. I hate this wheel, sorry about that. All the way into August 29th is where the peak is. So is that going to happen? I don't know. I think based on a weekly, I think this will moderate, and I still think there's going to be a stronger trend, possibly all the way into the end of August. And maybe finally at the end of Q3, we start to see some weakness. But when I talk about weakness from a macro viewpoint, economics, looking at weakness in the numbers coming in the economy, and everybody should know the economy is not the market and the market's not the economy, but this is being forecasted out. We're going with this, with the quant stuff. We'll try to keep some perspective with the macro analysis and all that, but this is basically what we're looking at from the standpoint of looking forward. We're still looking at upward bias. I said early on, buy the dip trade still on. Okay, so I'm getting, where am I getting? I'm getting long in the tooth here. So let's go ahead and take a quick look at NASDAQ. And you're going to see similar patterns. And what's interesting, NASDAQ has led the way as usual, right? Just a higher beta nature of that. We'll go into the mechanics or the statistical reason why this is happening, but it always happens because of that higher beta. But you can see we don't have the big forecast of the, elongated trend. So what we're likely to see is maybe the NASDAQ start to lead the way and then pull it down, and then ultimately the biggest laggard on the planet, the Russell, will collapse back in, and that'll be that for now. But this is really the same pattern. If you have the newsletter, use the Market Grid daily. I wish I could, and if you have the indicators, you can get the Market Grid by clicking here. I'll just do that. So Market Grid here on a weekly, this is actually going to be worth looking at real quick, is you're also seeing that a rollover coming or flattening, and what's happening, what's being forecast, these red dots are forecasting where things are likely to go. Doesn't mean they will, but this is staying. What this really is, you can see the orange lines here. They are forecasting the extreme high and low, and this is we had a break outside of them a number of weeks ago. Let me just see when that was, back in June, and then we still got that upward bias. And I talked about coming into this that we might see a rejection from this level, and really what we're seeing here is we're going to reject or go sideways right into this average, and it's not going to be, if we bring the forecast in. That's what I was talking about early. All of the forecasts looks like the peak of momentum will be at the end of August on the underlying. So, but if you look here on a weekly, the 21 is down here at 20,700. So we're just looking at that pattern continued to have an upward bias, but it's a much different configuration here. So let's take let's do a quick snapshot of the daily. And this is the one that kind of, if you recall, we could change the symbols real quick, but if you look at the NASDAQ, what's going on, it's a much flatter trajectory going forward than what we're seeing here on the S&P. I'm gonna flash over here real quick. Let's go back to the S&P. Look at this forecast going up versus the NASDAQ 100 is really flat. So what that most likely will tell us is that the S&P is going to be relatively stronger. So there'd be maybe a straddle trade there, long S&P, short NASDAQ. That's what is being forecasted. I don't know if that's the case going to happen, but we definitely have the support levels. Everything is much closer. So same thing here, market grid on daily, and you can look at weekly. Will be really in that big range here. Let me just bring that up over here. Yeah, so here's the range for the NASDAQ right now. This is the weekly range, okay? And we'll go back. No, that's daily. Excuse me. Sorry, I forgot. But yeah, so this is the daily range, and this is from right now until the close of Monday. So those are the predictions. So and we also have the market grid turning down a little bit. So that's why that upward range guardrail is going to be really good. Probably if we have run the fact sheet. So once again, Substack, kindlereport.substack.com, you'll get the data fact sheets for S&P, NASDAQ, gold, and Bitcoin. And so what you're seeing here is you're going to get more of this range bound. Should be pretty easy. It's going to be, Friday was it was completely dead, right? So you're looking at very, very narrow range on Friday. Oftentimes you get 2 or 3 of these narrow ranges, then you pull back, and the big number is going to be if I come here, a big number is going to be the 21-day moving average. But look at the forecast here. Everything's flat all the way into, really, as we come into next week. It's the interesting forecast when we come in. We're coming into after the Fed. There is a little forecasted downtrend there. So we'll see if that happens. All right, so let's see if I can get through this other stuff pretty fast. Let's go to let's bring up the treasuries. And this is something, I mean, we actually came a little short of fib target 3 here. What I've been talking about, and it's boring, but we're not going to make any moves, especially right now. We did see, since July, we saw rates uptick again. The range that I've been talking about, this range here, was about 0.25%. We're looking at 421 was the low print, and then we got up. I think the high print here, 449. I've been talking about 4.25, 450. And if it does downtick, which there is some basically stability in yields, especially on the long end. I keep telling everybody that I have a couple folks that are mortgage banker type that I consult, and I've been telling them that the back end of this curve is not going to change. It's going, and I've been saying that for a long time. Those who've been around. So the point is that the back end of the curve is going to stay elevated. I don't think the Fed does anything at this next meeting, but maybe September, October. I'm still looking for 50 basis points down on the front end of the curve, but even that's not. Everybody thinks, well, if the Fed lowers the rates on the front end of the curve, which they have done a couple of times, that the back end of the curve will change, and it hasn't. And there's a dynamic that's going on there, and this has been. I'm getting, it's appropriate here, talking about interest rates, but this has been the effort and the goals of the Fed. In my opinion, I said this maybe 2 years ago when they started to raise rates, that ultimately they're into a yield curve posture, and what they want to do, they want to see a steepening yield curve. Otherwise, the front end of the curve lower and the back end higher. And I told you what we would do is we would come into it was a flat line. So right now you get Fed funds 4 to 4.25, and you get the back end 4.25 to 450, and just using that spectrum, 2 year, all that stuff. None of that stuff matters. It actually never mattered, but a lot of people like to think it does. But the bottom line is that's has been the goal for a while, and then what they want is that steepening, and you will see a guy pretty positive if we can get 3.25 front end of the curve and a 4.25 back end. I will then be probably a Russell fan, but not a minute before. And I've been screaming about this for years, even though we managed to print a new high there on the Russell. It just came right back in, right? And so this will be where maybe Tom Lee is a perpetual bull at whatever comes out of his mouth. So he's going to be bullish on the Russell for the rest of your life. So just know that. You don't need to listen to him anymore now. But he's just going to be bull, bull, bull. It's going to go up. It's going to triple. It's going to quadruple. It's just stuff that comes out. He's actually the stick man they bring out on CNBC when they need somebody bullish, because he's always bullish. He's been a couple of times bearish, but not for very long. It's not in his nature. And all the funds of those guys are terrible. It's amazing. I don't know why anyone listens. Anyway, I'm done with. I always have somebody to trash on, to troll. So it used to be. I used to have fun with Peter Schiff. Peter Schiff he's right on gold. And how wrong is he in Bitcoin, right? So, but anyway. Let's see here. Treasuries, let's do $1. Look here. I get the right symbol. So Dower, interesting enough, is looking pretty good. I talked about a while ago that we might head down towards 95 handle. We got to 90, 96. And the forecast, if those of you have been around, you know that we were forecasting back, way back in early July that the dollar is going to appreciate a bit. It looks like it wants to keep going, ultimately probably get up around the, let me just bring this down so I get some numbers, 101 and a half, 102 and a half on the dollar, back towards the 200. 200 still declining. There's some right at the, looks like first week of August, there's a possibility of some more stability, but more appreciation. So the dollar looks pretty solid right now. So all the dollar bears are not going to get too far. All right, so let's move on. Let's go to gold real quick. Yeah, we're going to make it, and I'll be able to look and see what kind of questions and stuff you folks have. Gold is still forecasting to follow this slope. This is the daily. I want to show you the weekly. And this goes back discussions that we've been talking about for a while. So this is my caterpillar formation. So just get these ridges on here. We're finally getting the collapse, and I haven't talked about this for a while on the channel, but you get this normalization that happens. So when the market grid, this has happened in all of the equity indexes. We saw that big broad, and then we came into the squeeze, and then we get the trend. And now what we're seeing here, I think that the possibilities here on gold is that these fib targets that are above here still get satisfied. So 3650, 3840 is targets for gold. I think what this is probably of an ABC or an ABCX or a Elliott consolidation fourth wave that we get one more run to the upside here. And this is on a weekly basis that we're looking at right now. So this has been the case. The forecast, if those of you have been around, you know that this forecast was much steeper. It was like this parabolic curve. It's flattening out because of what's happening here. When you get these consolidations, then if I bring this back down, you can see momentum has also started to come in. The reflection of these dots that are out here are based also like on what's being forecasted here is what's being, you can see that it's all starting to flatten down and lower. So I think ultimately we could see, if I just come back to this chart, just looking at charts, doing analysis, there's at least a spike out of this pattern, probably satisfy on the upside 3600. But one more point, we're not getting confirmation on a PPMs. They're saying that we've got more work to do in here. So we're probably going to flow along the 21. So I'll update this as we go. But that formation, typically, if I just bring this up, this is the type of a ABC. There might be an X, another ABC. We stay within a broad range, and then we've got another pop, whether it hits the 36, 38 is a real number, I think, from a standpoint of expectations. All right, Bitcoin, and we are done. So I love that at 8 o'clock when I come live, that's where the new bar for the week starts and the day. So right now, we got a bit of a reversal last week. It was interesting because those of you on the market grid, we've got we had an RTX sell signal, which means that we should get 1 to 2 weeks sideways. Doesn't mean we can't pop up or whatever the range, but we did get a lower close. We closed that at 119, 135, and then we printed all the way up to 123.236 on this exchange, and then down all the way to 115, and then went out at right here at 117.30, off about $1,700 off the high. So you got a bit of reversal. This is kind of what I was talking about. It's not kind of, it is what I was talking about earlier. I was talking about earlier is that we're going to see the risk assets, just looking at the S&P, NASDAQ, this really, the last, I don't know, 6 weeks or so, we've kind of not really went along with the equities, but it's still a risk-on asset right now. We see once in a while it emerges as an alternative asset, but for the most part, it's really just a risk-on asset. So it's going to look like, at least from a forecast right now, this is going to be the case. So when we bring up the forecast for the PPMs, they're all showing lower prices. Therefore, all of the moving averages are flattening out. So there's that. I mean, the ultimate buy would be anything that looks like SMA 21. And right now, let's see if I can bring this up. I mean, it's not in play at all, but maybe in 3 weeks here, you'd be. That's interesting. Be back to 98. I think we stay above the 10, so I don't think that we're going to remain above that. We won't have any challenges, in my opinion, until maybe around the end of August. It looks like at the end of August is finally, maybe we'll be out of the summertime blues and start to move forward. So I'm looking at just that we should stay above the 10. This is a weekly chart. And let's just go and take a quick look at the noise on the daily. So daily is looking like as we come into the end of the month, we have some potential there. Let me change the scaling a bit. Since we printed that high, you can see on a daily, we're trying to fade in. 21 is going to be your big number. 114 is going to be solid support. You can buy off of there. I think, though, we've got a bit of a channel running to the downside, but I don't think it goes under 114, not at the moment anyway. And that upward slope is going to be changing every day, just to give you an idea. And then I'll come up for questions after this. But it's going up right now. It was 113,650. And then the next day, 114. So we're looking at about 350 per day. So that number, that support number, is going to climb 350 a day. Okay, so let's get a look at what you folks are talking about. Never use VWAP, probably never will. Somebody, Jeff is asking a question here. Yeah, so somebody, David Ford, dollar and gold rising together? Sure, why not? Dollar's been depressed, so it's recovering, and the gold's really forecasted sideways in that range, so no problem. Yeah, so Harry Toe, appreciate that. I'm not saying I'm talking from an indices standpoint. I've got a portfolio that I run on a Russell, does incredibly well. It's not all the stocks in a Russell, it's the index. because there's a lot of deadbeat companies in there. So let's just see here. Yeah, if you look, Harry, if you look at the relative performance, if you're a good stock picker and you're talking about the small and mid, yeah, there's been some great trades in there. I'm talking from an index standpoint, and indexes are up. None of those indexes made new highs. They're not on a relative. If you do a spread versus anything, those are all deadbeats. Not that there's not good things. Let's see here. So what am I missing here, David? Nothing like after the fact indicators, e.g. trend. Oh yeah, absolutely. But this is a thing on trend lines. I need to do an entire video on trend lines. Here's the trend lines aren't the problem, and you can find some good breakout points. I'm not saying they don't work totally. What they do is they do something that's way more detrimental. Is when everything we do around markets has probabilities, and if you put too much belief in the so a trend line is a static line to infinity, right? And that's one of the problems. The other problem is psychological. You can believe in them, and that's where you really get in trouble. And anybody who's traded, use trend lines, knows what I'm talking about, okay? Because there's this static line, there's two things that I look at when people post. I have not as many. I have about maybe 20,000 followers on LinkedIn, right? But on LinkedIn, there's when I see some of these analysts, air quotes, and they are doing spread chart comparison, and they're telling you that the NASDAQ versus this has never been this low, and they draw these conclusions from them. None of those. Very few of those, I'll go this route. Very few of those will ever really be of any use to your positioning. Sometimes they can be, but it's one of those where anytime somebody talks in percentages, I know they're lying. Including, I've watched like this stuff reporting on a crime, like doesn't matter. Some news anchor comes up and says, oh, the crime rates are up 820%. I saw a number the other day. They were touting something 820%. What they're not telling you is what the numbers were. So let's say the numbers were 3, and now they're 15. Okay, they're not giving you the material background because what they want is the narrative that the percentages is going to make you think. There's a book I always tell you folks you should read it. It was How to Lie Through Statistics. I read that book 20, 30 years ago, right? And it's a great book, and I ran across it by accident, but it turns out it's like the journalism Bible, and it was written, I think, in 1954. And if you want to lie to somebody or you want to sound exciting, you can tell them your account's up 50% last week and you had $25, now you have 50. If you talk exact numbers, it's easy to make things look or perceive or to communicate something that is such a big deal, even though maybe it is not. So I love when I see those comments. Yeah. So like I said, I read the book. Yeah. So this is my Jeff. A great question. He's asking about the VWAP. Listen, I really don't care if you use VWAP and you like it, but I am kind of having been a floor trader, not just a desk institutional trader upstairs, but a floor trader for many years. Is volume is not that important to me, and in fact, there's probably a couple of videos I should do. One on trend lines, and one on volume and the use of volume to make decisions. I always say that the day they take prices away because they didn't trade enough. Like for example, I do this example all the time. I can do it in where we at. We're a little bit over, but I was late, so I owe you folks. But the one of the things that happen is volume doesn't like people think, oh, there's big volumes, so that means it's going to go on. A lot of times big volume is climactic in nature, so there's a context that has to be. Volume in itself is not a very good indicator, just because I've seen lots of volume and I've seen crazy trading going on live when we used to yell and scream and spit on each other to trade. That it's just not that important to me. You notice that I don't have any volume charts. I never talk about it. Those you've been around for lots of years, you know that. And the only reason is I don't care about it. All I care about, I'm a price discovery only. And we've seen situations, you folks have been around, when we get into this, like for instance on the Liberation Day, we saw liquidity just blow up. It went away. And liquidity to me is not how much they trade in a day, but how much liquidity is on one bid to the next offer. And that liquidity is what drives that. So I've talked about it a lot randomly, like now at the end of a hour and 4-minute video, no one ever sees this stuff. So I need to really take a lot of these lessons that I throw in these videos and put them out, because they're significant just from the standpoint from experience to give you some knowledge. So VWAP means they're waiting because of the volume. Somehow there's more volume, and that makes prices more valuable. It's the same thing with any of the weighted. I don't think that today and the last 3 days volume and prices and all that makes them more valid than the one that happened 10 days ago. I think they're just all data points. So the way that I've looked at data for a long time, I got to be careful, because there's a whole master class right now in my head. But the bottom line is, those things aren't as important. And this is what happens, okay? So I'm going to try to close this loop, is that what happens with trend lines and with the VWAP and all that stuff, what you're trying to do, you have to understand, every trade that you ever will make, you're selling yourself on that trade. You're trying to find something that validates it at a level you're willing to take on risk, okay? And if you have bad metrics and you're making decisions around those things, and this is why I talk to people about journaling and really getting deep into their decision process, because that's way more important. So you have to be careful on the types of things that you let make those decisions for you. And really what's happening is like, oh, it had big volume in this, and you add it all up and you go buy. And then if you lose on that trade, you just need to journal around that and look at the other things around. We're very fortunate, folks. I'm glad to be alive today, and I'll tell you why. Is you can take if you get enough data, you can now go into Chat or Claude or multiple platforms now, maybe Gronk. I've not used Gronk much other than making a few images for my YouTube channel. But the bottom line is, we can go in and try to run some heavy-duty math on this. Monte Carlo simulations are BS. They should say money BS. Those things are virtually worthless. I've seen a whole bunch of money managers and advisors use that stuff. It's a joke. But understand that if you're a trader, you have to sell yourself into trading the risk. And so I've talked a lot about this. I've done a couple classes on this, but I'd like to get some videos out there to really talk to people, because when we're doing analysis on this channel, we're just talking, okay? If we're putting money to risk, we need to validate those data points and all those things that happen. And that's if you don't have a winning record and what decisions you're making, you've got to break down and look at everything that you're making. I'll tell you one more little tidbit. Those of you that have read the old like the first Market Wizard book. There was a guy named Ed Sakota, and I got invited to a party. This, I'm trying to think what year, probably maybe 1983, 84. We went to Ed's house. He had a big house on Lake Tahoe. We went up there, and there were 10 of us, and so we actually were nerds, and we did a lot of research. So I need to do a video on that because I learned a lot from that particular meeting. But what really came out of that is that some of the things I already had context there. You have to remember, I started in 1979. So this was, early on in the long career that I would end up having. And so the result of this is that what came out of that was, you really have to have the old saying, and everybody knows this, there's a million videos on what I'm about to say, but it's easier said than achieved, is that you have to come up with that criteria you have to trade with. And what we did at that meeting, there were 10 of us, and we had to present our last 10 trades, win, lose, draw, whatever they were. That was the theory behind it. And we had to explain our trading process and from top to bottom in 20 minutes, okay? And what we broke in groups. We evaluated the guy that was talking and presenting, and there were a lot of very interesting people. One guy was a successful professor trader, and myself, and there were some there were two Goldman Sachs guys there that were managing directors. So there was some pretty heavy, and Ed himself was the market wizard, right? So he had a pretty interesting background. But I tell you all this, this kind of triggered me. These are the best. I probably should just do a video and just answer questions, see what comes up. We used to do this back in the day when we were all locked behind our desk. But the bottom line is, any decision you're going to make, I'll leave it. I'm going to close it out here. Every decision you make, you have to sell to yourself to make to take on the risk. And if you don't structure a good strategy around there, otherwise, I don't use stop losses myself. I use position sizing to change risk, and I have some techniques, so I don't do that. So I have a large enough capital base to do some techniques that you need have, but with the micros, some of the stuff you can still do. But the bottom line is, you have to, this is my old saying, I've been saying this for decades, right? The last time you were objective is before you put the money in the market. Once you buy the trade, you now believe in it because you put the risk in it. You did all that. You sold it to yourself really, really good. And you had 15 reasons, 100 reasons why it was going to work. And so now you are now subjective once you put your money into this. And what happens out of that is scary. Because if you don't set up the trade before you get in, then you're going to be 100% subjective, and you're going to be reacting to what happens in front of you. You're going to throw in a random stop. You're going to get guaranteed to be stopped out, right? And then you're going to, in your mind, going, oh, these bad, evil traders found out where my stops are, my little 2-lot stop, and they went and stopped me out. That's not how it works, okay? That's just stupid. Anybody is telling you that the traders seek out trades. I've been on floor pits. I've been on big trading desks. Nobody knows where this stuff is. You can guess. Say, oh, I think they're under the even dollar or whatever. Maybe they are, maybe they aren't. But my point is, so once you structure that trade, entry, risk point, and then I have a 3-step way of eliminating risk within a trade structure, and then a target, right? And then you've got to keep your everything you sold to yourself. You've got to be responsible and make sure you do those things. And if you don't, you should write down what that trade went like and start to learn from your mistakes. My old slogan back in the mid 80s was, I only make the same mistake 55 times. It was a Fibonacci number, so I just used that, but it was a joke because I did the same trade just like everybody does and did the same stupid mistakes every time. So ultimately, by journaling and doing everything I talked about, is what you're going to get is the perspective and that understanding and the experience and know where your mistakes are. And that's how you get to be a little bit better by trade, week by week, month by month, and year by year. So I always compare myself to Tom Brady. I can see in the order book, I can see things that are going on there. I've tried hard to try to explain what I'm seeing, but I've said in front of, I have a screen up on top up here that I've used that same screen, I think, since 2003 maybe. So for the last 22 years, when I look up a screen for my day trading, I have all the metrics I want. That's my screen, and it still feels good when I look at it. I don't have this need to modernize or do anything. It's got everything there, and it's all there. So anyway, you guys just got a free one. Sign up for my newsletter, kendallreport.substack.com. So you never know what's going to trigger me on one of those rants. Yeah. So yeah, you folks would be surprised at the people that I know. I've actually I've talked about it. I don't want to troll Ed, but I'll say this because when Ed presented at this meeting, everybody looked at me like I had 10 heads, okay? Because he was the host of the meeting, but I thought our job was to critique. And I looked at him after he presented and said, I thought people that did that lost all their money. So maybe I'm wrong. It turns out, anyway, I'm not going to tell that story. But yeah, so, but I'm just looking here. Yeah, folks, listen, I wish I had a way to get the vast knowledge and experience that I have. There's a lot of things that you just have to do yourself. So this end of this video should be clipped and be a video in itself. But that's not going to happen because I don't have the time. So, so maybe there'll be some AI that I'll be able to run this through and tell it to look for certain things. But yeah, but just know that's what we're doing ourselves. Discretionary trading. Well, I'm 17 minutes over, so I am going. Discretionary trading is the hardest thing you'll ever do, and it's not impossible, but it's hard. You're looking at a guy that's been a trader for all these years. I built 2 platforms, WaveTech, and I've got Portfolio Expert, which is our money management platforms. And those models, even all the models and the database I show you every day, those are non-emotional models. And those models were actually built, came out of 1986 beginning, kind of solidified in 1992 over many years of use, and then really came into code because technology was moving ahead during those times. So there's a whole interesting story behind all the technology, but the models themselves were built for one reason, to get rid of everything I just talked about. All I could do, I can now go into a stock symbol or ETF or whatever, and I can look at the stats. And those who've been around, I am rebuilding the WaveTech platform. I have multiple reports now that have probabilities, and I'm excited because I've been able to ask questions about the models that I've been wanting for years, and I've fed a lot of data into this, and scrutinizing and even challenging. Because if you're working with AI, if you just take every answer, oh, okay, that's it, you got to challenge, especially when you're doing deep research. You have to challenge what comes out of that thing. And you challenge it if you have the knowledge and you know some of the characteristics, because when you challenge it, it'll go, oh yeah, you're right, this is not, all that kind of stuff. Oh, it's like, my bad, I should have done it the way you just suggested. So I have the background, And anybody that's out there that has expertise in some area, you want to challenge any answer. Don't accept it, but challenge it a couple ways, especially if you know for a fact that those are not things, or from experience that doesn't work. If you challenge it, it will go a little deeper. So be careful with that stuff. But anyway, yeah, trading's hard. Okay, and I'm suspecting that everybody on here right now, and everybody's going to watch this video, you've all traded, right? And it's hard. It's very hard, and it's frustrating. And it's everything, and it's psychological, and it's everything. It's a giant pit that you fall into, and you can get obsessed and absolutely burn every dollar you have if you're trying to do stuff. But if you go back and listen to when I started this little rant, and I can't remember who asked the question, but thank you for doing that, because these triggers when these things happen, these are insights. Just they're pretty generic what I've just talked to you about, but these are things if you start to look into them. I'll have to look at this because I've been considering. I did a master class of some sort a couple years ago, and I finally found some videos where they're being hosted. So I'm looking at that, maybe releasing, because a lot of this type of stuff is, when I talk about, you folks just got a 20-minute free seminar, okay? And this is, but the amount, I could actually do what we're doing right now, we could do for weeks. It could be a university class, and some people, I've been called, sometimes a couple of times I've been called the professor, and one of my mentors, that's what we called him, was professor. He wasn't actually a professor, but he was, because he really knew this stuff really well. So yeah, so thanks everybody. This is what this stuff is all about. Yeah, so just quick, David Forster, even with models, you don't get excited. Well, here's why I built WaveTech, and this is a individual model trade. If you only trade one, let's say one financial symbol, right, and you're running a model on it, that's just a model. The reason why have been able to make really good returns for decades using models is we're combining models on 20 and 30 items within a context of a portfolio, and that software is able to allocate the assets and reallocate the assets based on some one of the probably most significant things that we built. And I know my old partner Dave watched, so I'll give you I told you I would always give you this credit, but one of the things that we built was this allocation system, and it basically causes an acceleration of capital when you're in a portfolio environment. And people think, you get out the best you can get out, and like I bought the high and you did the perfect trade on every stock in your portfolio would do really good. It won't, and not with what we figured out. We figured out how to reallocate profits from winning trades into new trades, change probabilities of all kinds of stuff. We did that in 1998, okay? And we had a couple spreadsheets and an old database, old DB database that we ran. But we were able to figure out stuff. David figured it out. So we tried a little bit of everything for about a year, and we finally figured out the magic formula. And I tell you, in the .com days, I mean, it was crazy. I mean, we had portfolios printing 150, 175% returns with big money, with not retail money. Okay, we had one manager that cranked a 175, and I think the next year he brought. This was 1998. He brought in like $400 million of new money, because everybody wanted to be his friend. And so there are the models are models, and they're going to win and lose. And I've also been doing that with our software and looking at trades, consecutive winners, losers. I could go on and on, folks. I'm now into 25 minutes over, but this conversations, any of these conversations are multiple hours and days that could be had. So maybe what I need to do is try to capture these moments and get on and just go on and on. It just seems to be, I'm pretty good at talking to the camera, and the stuff just flows out. It's natural. What you know what you know when you can just talk for hours, and it's because while you're talking about it, you know the successes and things you had. So I appreciate everybody who's been hanging out, listening to me rattle on. I can't find a way out, but I'm just gonna close the door and leave. So anyway, thanks again for watching. Like I said, just those of you hanging around, I'm not sure what's going to happen the rest of the week, but I'd rewatch. I think there's some pretty good information I just gave you. I'd rewatch this last 25 minutes for a few more times. And I appreciate it. It's like, yeah, the rants are awesome. See, this is the other thing I'm trying to find, like somebody. I've got a couple people I know that would be fun for us to rant back and forth for a while, a more podcast type thing. I've been kicking that around for a couple of years, but I appreciate it. Tell your friends, subscribe, do all that stuff. Get the newsletter, get the indicators. The newsletter, kendallreport.substack.com, and then the indicators are kendallreport.com/indicators. Okay. And I think if it doesn't come up right, you can do indicators 24 if that happens. So should be there. And there are some exciting things we're going to do together as we go forward. So keep hanging out, get more friends. I'd like to bust over 50,000 on the channel. YouTube doesn't like me. I think I said pandemic 5 times tonight, 6 counting that one. So they throttle this channel they have for years. But those of you that found it, share it, and we'll go forward. Have a great day. Hopefully I'll see you tomorrow night. Take care.